Okay, so now we're going to talk about the concept of imputed interest and how this is treated on related party transactions for tax purposes. So why does the IRS include this imputed interest? Well, imagine lending a friend $100 to snag those coveted Taylor Swift tickets. But you say, let's consider this a loan, but I'm not going to charge you interest. We're just going to shake it off. No pun intended. So this is a very basic example of what would be considered a below market loan. Okay, so below market loans. A loan whose rate per the market is less than the applicable federal rate. Okay, so the applicable federal rate is set by the Internal Revenue Service, the IRS. So for instance, if a parent lends money to a child at 0% interest, the IRS might treat the transaction as if the parent lent the money at the applicable federal rate and then gifted the interest amount to the child. So the parent would then have to report the imputed interest as income, even though they didn't actually receive any interest. Okay, so the IRS is basically saying, hey, wait a minute. We make our money by taxing interest. We still want our money. So the IRS, being the IRS, says, you know what? We just don't care. We're going to charge you interest income anyway, even if you didn't make any interest on this transaction. Okay, so the IRS is going to slap on what's called this imputed interest rate. So you could think of this as the pretend interest rate, and that's so that the IRS gets its money. Okay, so let's go through an example. John lends his friend Sarah $10,000 with a promise that Sarah will repay the $10,000 in 1 year. John doesn't charge any interest. However, let's say that the applicable federal rate, right, the AFR, for a 1-year loan is 3%. So the IRS expects that John should charge Sarah at least 3% interest on the loan. And this means that on a loan of $10,000, John should receive $300 in interest over the year. So let's talk about the imputed interest calculation. Even though John didn't charge any interest for tax purposes, the IRS still treats the situation as if he did. Okay, so John charged Sarah 3% interest. So how does this impact John's tax return? He's still going to need to list this as interest income on his tax return. Okay, so individuals who make below market loans must report foregone interest as interest income on their tax return. And at this point, you might be aware of the fact that interest expenses are potentially deductible to the borrower. So they still may be deductible for interest expenses on below market loans for funds that they borrowed. But Joey, if the individual isn't paying any interest, how can they deduct interest expenses if they never paid it? So remember, this is make-believe interest, right? This is pretend interest that the IRS is slapping on so that they can tax something and get their money. Okay, so I want you to remember that the tax return is its own story in itself. And in this story, the IRS is making up this pretend imputed interest amount. So it's going to treat it as normal interest. So that's great for the borrower. Not only do they actually not have to pay any interest, but they also get to deduct it as if they did. Okay, so assuming that this is a business loan, all right, so the imputed interest guidelines primarily concern to these types of below market loans. They will apply to gift loans, work-related loans, or business owner loans. Okay, so a gift loan is a type of loan where there's either no interest or the interest rate is below the market rate, typically given without the expectation of making a profit from the interest. All right, so this kind of loan is usually between family or close friends. So let's say that Lisa decides to help her brother Mark buy his first car. Mark finds a great deal on a car for $5,000, but doesn't have the money right away. So Lisa, wanting to support her brother, lends him the full amount without charging any interest, with the agreement that he'll pay her back in a year. In this scenario, the money that Lisa lends to Mark is considered a gift loan because she's not charging him the market rate of interest on the amount that she lent. Instead, she's providing the loan primarily out of the generosity and kindness of her own heart. All right, so a work-related loan is a loan typically given again at below market interest rates or without any interest. And this is often between an employer and an employee, or between a contractor and their client. So John's company lends him $2,000 to attend a training course, charging no interest. He agrees to pay it back over the next 6 months through paycheck deductions. So this is a work-related loan because it's provided by the employer for a job-related purpose and lacks the usual interest. All right, so let's say now that we have a business owner loan. And this is a loan made once again at below market interest rates or without any interest. And now this is typically between a corporation and one of its shareholders. So let's say that TechCorp lends its co-founder Alex $10,000 for a business project without interest. Alex commits to repaying it within a year. This interest-free arrangement between the corporation and its shareholders exemplifies a business owner loan. Now, we're trying to determine the imputed interest amount. So you're going to want to calculate the interest that would accrue at the applicable federal rate, since no actual interest was charged. All right, so we're going to calculate the interest at the AFR of 4%, which is $50,000 times 0.04. All right, so that's why $2,000 is what our calculation would be, right? Since no interest was actually charged on the loan, then the entire AFR interest amount is the imputed interest. Okay, so the imputed interest for the first year is $2,000. So taking a look at this question, we're trying to determine the imputed interest. So we first need to find out what the interest rate should have been if the loan was given at the applicable federal rate of 3%. Then we'll subtract the actual interest charged at 0.5% to find the imputed interest for the first year. So start by calculating the interest at the AFR of 3% of $100,000, right? That's $3,000. So this means if the loan was given at the AFR, then your friend would owe you $3,000 in interest for the first year. So next, let's find out how much interest your friend would owe you at the given rate of 0.5%, right? 0.5% of $100,000 is $500. So now what we're going to do is subtract the actual interest charged of $500 from the interest at the AFR of $3,000 to get the imputed interest of $3,000 minus $500, which would be $2,500. Okay, so that's why the correct answer is $2,500. All right, so taking a look at some of the incorrect answer choices. $2,000 would not be correct because this would be the result if we subtracted 1% of $100,000 from 3%, not 0.5%. All right, so $3,000 would be incorrect because this is the amount of interest at the AFR, but it doesn't account for the actual interest charged, right? We would need to subtract that amount, right? That $500. And $3,500 is incorrect because this is greater than the interest at the AFR, right? It doesn't make sense. Maybe if we were adding that interest of 0.5 times 100, maybe that's where they're going with it. But overall, that's why this is incorrect. The correct answer choice here is going to be that we are going to want to prevent tax evasion through low or no interest loans. Okay, so the concept behind imputed interest is primarily to ensure that loans, especially between related parties like family members, are not used as a means to transfer wealth without paying taxes. So by imputing interest, the IRS ensures that a minimum amount of interest based on this AFR is recognized and subsequently taxed, even if no actual interest was charged on the loan. So remember, this is our pretend interest. The IRS wants its money. Okay, so to provide tax benefits to borrowers would be incorrect because imputed interest is not about providing tax benefits. Instead, it's about ensuring that a fair amount of interest is recognized for tax purposes on loans that might not have any or very low interest. Okay, so thus potentially increasing tax liabilities. To ensure lenders charge high interest rates is also incorrect because, again, the concept of imputed interest doesn't force lenders to charge high rates. It merely sets a minimum interest rate based on AFR for tax recognition purposes. So lenders can still charge rates below this, but the IRS is going to consider the AFR when determining the potential tax implications, aka taxable as interest income to the lender and potentially deductible as an interest expense to the borrower. Okay, and finally, to standardize global loan practices is also incorrect because imputed interest is primarily a U.S. tax concept, right? It does not aim to standardize global loan practices. So different countries may have their own rules and regulations regarding intra-family or below market loans. So that's why this would also be incorrect.